Offshore banking, how to open accounts, diversify currency, and avoid the one basket trap. 1. Is offshore banking legal? Yes. Despite the mystery surrounding it, offshore banking is legal in almost every jurisdiction. Some governments, like the United States, simply require disclosure forms. That means, tell them where your accounts are, how much is in them, and pay your taxes accordingly. The point isn't hiding money. The point is diversifying it. Footnote: offshore accounts are legal if properly disclosed, especially under U.S. tax rules. 2. Why bother with offshore accounts? Diversification is the first reason. If one banking system stumbles, you have a fallback. Some banks abroad are stronger, more conservative, and less likely to collapse. Others offer higher interest rates or access to investments unavailable at home. Think of it as spreading eggs across baskets, but some baskets happen to be in Singapore or Dubai. So what does that actually mean? It means you sleep better knowing all your savings aren't tied to the fate of one country's regulators. Footnote: offshore accounts spread risk across currencies, jurisdictions, and institutions. 3. Different types of accounts. Not all accounts are the same. Retail accounts work like the debit card account you open at home. Priority accounts require larger deposits, often 6 figures, and come with multi-currency services, investment access, and better online tools. Private banking? That's for clients who want someone else managing their money. Sounds convenient, but private bankers often oversell themselves and underdeliver. Footnote: offshore banking offers retail, priority, and private accounts, each with distinct costs and benefits. 4. Where to open them? If you only have a small amount, head to countries like Georgia, Azerbaijan, or Cambodia, though options shrink each year. If you're after bigger opportunities, Singapore, the Bahamas, or the UAE cater to higher deposits. Residency or property ownership often unlocks better access. Translation: sometimes you need a visa, not just a passport, to get through the banking door. Footnote: residency and property ownership often improve eligibility for offshore accounts. 5. Remote versus in-person. Some banks allow remote openings. Sounds easy, right? Until you face 40 pages of paperwork and endless demands for notarized documents. Going in person is usually smoother. You build trust, shake hands, and see the system yourself. And frankly, showing up in board shorts and flip-flops in Singapore won't help. Dress like you're serious. Footnote: remote account opening is possible, but in-person visits usually simplify the process. 6. Start small, build bigger. Many banks let you test the system with small deposits, sometimes $500 or $1,000. Once the account is alive, you can wire in more later. This is the tunnel strategy. Build the pathway now, fund it later. When domestic banks wobble, you'll already have the escape hatch open. Footnote: small deposits establish accounts early, allowing for larger transfers when needed. 7. Strategy matters. No single account solves everything. Some accounts work for payments, others for investments, others for holding property income. Building a portfolio of accounts, retail here, priority there, is smarter than expecting one Swiss banker to do it all. This isn't James Bond. It's asset protection with debit cards. Footnote: diversification means building multiple accounts across jurisdictions for different needs.